Good morning and welcome to this Monday, August 15th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it is option expiration week. We will see whether or not that can slow down this raging bull market that we've had off the June low. S&P 500, NASDAQ both up more than 20% from their June low, which has been a pretty nice rally here over the last 2 months. It's been almost 2 months now since that bottom went in. That was June 16th and 17th, where we kind of put that double bottom in down around, I think 16th was 36.39 and the 17th was 36.36 on the S&P 500. We closed yesterday, almost 2 months later, 42.80. So it's been more than 600, close to 650 points up on the S&P 500. And so the question is, where do we go from here? I'm nervous this week. And I'm not nervous about the bull market. I'm just nervous because there's a lot of money on the line for market makers. There's a ton of in-the-money calls. We remember that rally that we had back in March on the S&P 500 that came out of nowhere. We were down at the low back on March 14th. You can go back and look at it on the chart. We had just hit, I believe it was our low close of 2022, had gone considerably lower. There was almost nothing but in the money puts. There were hardly any in the money calls. And so at that point, we talked about the risk of a short-term move back to the upside, and the market absolutely soared over the next 4 days. Now, I'm not calling for a major collapse here over the next 4 days, 5 days, but, I always talk about managing risk. It's not about being right or wrong. It's about managing risk. I think it's very risky this week. I would be very careful. I certainly would not be in any leveraged ETFs on the long side. That's just my opinion. Maybe they go up. Maybe the market just keeps rolling. It's possible. The one thing I always say about Max Pain Week, options expiration, is market makers, they're not going to lose money if prices don't go in the direction of Max Pain. It's just that they can make a lot more money. And anytime market makers have financial incentive to head in one direction or the other, I pay attention. And this is the one time of when the monthly options expires, this is one time when there's a ton of money on the table. And you just got to be careful and at least recognize which way market makers would like to see prices go. I mean, last week's volume was not that great. When volume's light, that's when market makers can put their capital to work. Trust me, there's a lot of bears out there right now. It wouldn't take much to get things rolling back to the downside and to see more selling. So this is going to be an interesting week, and we're going to get into all that in just a minute. But first, let me go ahead and take you over to EarningsBeats. For those of you who are new to EarningsBeats or to the show, first of all, welcome for sure. Always glad to have new folks joining us here at EarningsBeats. If you go over to EarningsBeats.com and you are new, or even if you're not new, if you've been with us for a while, if you're not already an EarningsBeats Digest subscriber, I would just highly recommend that you sign up. This is a free newsletter. I think it's the best free newsletter you're going to get. I think there's a lot of value in this newsletter. All it takes is name and email address. No credit card required. You can unsubscribe at any time. Just type in your name, email address, hit that subscribe button. I write the articles 3 times a week, Mondays, Wednesdays, and Fridays. And when I say articles, maybe that's a little loose. It's usually 2 paragraphs in a chart. It's a very quick read. Sometimes it has to do with the S&P 500. I might be talking about something I think is big, as far as directionally, which way I think we could go. It could have something to do with options expiring. It could have something to do with earnings that are either coming out or have already come out, relative strength, candlesticks, the volume, trend lines, moving averages. I mean, it could have to do with anything. Try to make it very educational. Some of our subscribers use it for trading candidates and opportunities. That's completely up to you. But I think it's a great newsletter, something especially if you want to get others involved in the stock market that maybe don't follow very closely. I think, just turning them on to our free newsletter would be a great way to get them started. So think about that. Share the link. Make sure everybody that you can think of is on board. But I think it's a great newsletter. Of course, I'm a little biased since I write it, but I do try to make it very educational. The second thing I want to point out is we have a huge event coming up on Saturday, August 27th at 10 a.m. It's a free event. Cost is zero. It's going to be very similar to these market vision events. You've heard me talk about, some of the things I talked about back in January about how I thought the market could fall 20 to 25% or 20 to 30%, I think is what I had said back then. Back then, the S&P 500 was 46, 4,700. I thought we could drop down to 35, 3,800. We hit a low of 36, 36. I'm just giving you my thoughts. I'm not saying that I'm going to have the perfect prediction, but I'm going to tell you what I think about the way the market's trading, the clues that it's giving us, and that's what I look for. I look at the charts for a story. I don't look at the charts for guarantees. I look at the charts for a story and to help me manage risk. Hopefully, it increases my odds, but I know I've been around this way, way, way too long to know there are no guarantees in the stock market. But I do think we can look at a lot of signals, the signs that the market's giving us, and make a very educated guess on whether we want to be in the market, fully in the market, whether we want to be a little cautious, maybe tiptoeing, still on the bullish side, but maybe being a little cautious, or whether we just want to be out. Beginning of the year, we wanted to be out. There was just too many warning signs. So anyway, getting back to this, August 27th, I'm going to give you my outlook for the rest of the year and into the beginning part of 2023. Where do I think the market's going and why? And you can disagree with me. Markets, you got debates on both sides, bull and bear. Hopefully I'm right more often than I'm wrong, but I'm certainly not going to be right all the time. But I'm going to give you a lot of the things I'm thinking about, a lot of the things I'm seeing, and then you can decide for yourself. Do you want to take that risk? Because that's really what it comes down to. Do I want to take the risk of being in the market? Can I afford to take the risk? Those are questions I can't answer for everyone. I can only answer that for myself. All right, let's move on. Take a look at what happened on Friday to close out last week. Dow Jones Industrial Average, it was a really good day to finish the week. I mean, it was one of those trend days where a little choppy in the morning, but mostly higher, and then just solidly higher throughout the rest of the day. I mean, the market it seemed like there were no sellers. Dow Jones up 1.25%, 424 points. S&P up close to 1.75%, up 73 points. There's that 4280 I talked about. NASDAQ up 267 points. That was more than 2%. On Friday, we busted back through 13,000. Our low was down near 10.5. We're 2,500 points off the bottom. And I still am reading all these articles about this is a bear market rally. This is a bear market rally. Good luck. That's all I got to say. Mid caps up 39 points, up 1.5%. Small caps up 1.8, almost 1.9%, 23 points. Both small caps, mid caps, NASDAQ, S&P, and the Dow have all now gone above that reaction high in June. I mean, when I called the bottom in June, it was based on rotation, had nothing to do with price action. You can see it mid-June, we were at new lows. Had nothing to do with that. I mean, obviously, I had people writing in, oh, the momentum indicators are showing no signs. Well, of course, they're not showing any signs. Momentum indicators, market's at a new low. What I was looking at was Wall Street moving into more aggressive areas, seeing money rotate. That's what I saw at the top when I talked about that. So that's what I was looking at back then. Since then, my gosh, we've gone through moving averages. We've been led by consumer discretionary and technology off of that bottom. This isn't being led by healthcare and consumer staples. Money is rotating into aggressive areas. And perhaps the most amazing thing is sentiment has remained somewhat cautious, not nearly as bearish as it was, but nowhere near the complacency we saw at the end of last year. I mean, there's still a lot of doubt in the options world, which is perfect. That's awesome. That was the resetting of sentiment I talked about at the beginning of the year. This is what we want. Anyhow, from a sector perspective on Friday, discretionary up 2.25%, technology up almost 2%, materials 1.9%, communication services, this is a group still needs some work, but looking better, 1.8% rise there. And then real estate crept into the top 5, up 1.7%. All 11 sectors up on Friday. 10-year Treasury yield. Let's get the latest here. 2.797, so about 2.80%. We are down 5 basis points. So after surging with our inflation reports last week, we did see interest rates surge back above that 20-day moving average, but now right back down below again. Seems like just a little bit of consolidation here, but I think the overall trend is lower. We hit 3.48%. And I want to show you something on this long-term chart on the 10-year Treasury yield. First of all, from a monthly perspective, you can kind of see this was a head fake. That is basically, that's close to 3.25% right there. So here we were above 3.25% back in 2011, but we've been trending lower. Here we got back up close to 3.25. This was the high back in 2018, right before the trade war debacle, where we were up to 3.25%. Just 2 months ago, back in June, when the market was at its bottom, stock market was at the bottom, 10-year Treasury yield was at a high. There was that 3.48%. But look at that on a monthly chart. It was a failure. It was a false breakout. And now back down we go. You can see the 20-month moving average, which has been pretty much support, is sitting back down just over 2%. I've said before, I think this year we're going to go back down close to 2%, maybe between 2 and 2.25 is what I believe we're going to see. I think the Fed will completely come off of its rate hiking campaign. Still a lot of folks looking for 75 basis points in September. Personally, I'll be shocked if we see another 75 basis point hike. I think it will be a big mistake by the Fed that they'll quickly have to reverse if they do it. Could they do another quarter or a half? Maybe. I think they should just sit on their heels and watch, because after those 2 inflation reports came out last month, the PPI headline was negative, which I had said wouldn't surprise me if one of those headline numbers was negative. Well, it was PPI expected to rise 0.3%. It lost 0.5%. So raising rates when inflation seems to be starting to at least peak and roll over is not a great thing to do when you also have a recession that you're dealing with. I mean, I agree with the Fed. You want to make sure inflation's knocked out before you move on to the recession. But last month's report may not have been a knockout, but it was a couple of good body punches. We'll see what happens from here. But anyway, 10-year Treasury yield right now looks to me like it's topped, rolling over. I'm not sure we're done as far as going higher. Remember, we're sitting close to record levels or record low levels on the 10-year Treasury yield. I mean, this was crazy down here. This rate in here, 1.5%, was already down to all-time lows. So if we go back down to 2%, that's still sitting really, really low. And if inflation's back under control and the economy begins to pick back up again later this year into next year, I expect the 10-year Treasury yield will probably, after going back down, maybe move back up again. But anyway, that's just my look at interest rates, both in the short term and give you a little bit more longer term perspective. All right, S&P 500. Moving on to talking technically. I was a little surprised by Friday's action. I'll be honest. I thought when we went up and reversed and closed at the low on Thursday, I figured that was probably it through options expiration. I just, I was looking at all the in-the-money calls. And the only thing that matters really with options expiration is where we are really Friday or into early next week. And the reason you can go into early next week, even though options expire this week, is that you got a lot of folks within the money calls that can exercise. So they can go from having in the money calls to exercising, actually buying the stock. And where does that leave market makers? Instead of on the short side of the calls, they're on the short side of the stock, still with incentive to move prices lower. That's why I always talk about options expiration. There can be an impact throughout option expiration week, but then also into the early part of the following week. Anyhow, that move on Friday was pretty shocking to me. I mean, we've had a couple of tests up around 4,300. I did say that if we went through 4,176, that 4,300 would be next. And I thought we got close to that with that reversal. Anyhow, kept going. Now the next level is 4,300. Could we blast through 4,300? Sure. Market can do anything. I'm just saying there's a lot of money on the table for market makers to reverse things. That's why if I was in the market, especially with like the QLD or the SSO? I think that's the 2 times bullish S&P? Yeah, that's the Ultra S&P 500. So if I was in the SSO or the QLD, which tracks the major indices at a 2-to-1 clip, I personally would sell it. If you want to be in the market, just sell it and get into the QQQ or the Spider. I just wouldn't be doubling my risk at this point, at this juncture. Not because I don't like the stock market. I do. I believe we're going higher. I just believe this week is a week that I would be more cautious, which means I would not be in the leveraged ETFs. So I'm much more cautious. I'm not in right now in my trading account. I'm not in at all on the long side. I'm nervous short term. If market keeps going up, that's great. I don't care. I just don't want to put my money at risk right now. And that's a short-term call. I don't want anybody to be confused by my long-term call where I said it was the bottom. If I was thinking a year out from now, 6 months even, 3 months even, I would be in the market. If I didn't have the option of trading and I had to make a call, do I want to be in the market next 3 months or 6 months? Do I not want to be in? Absolutely, I would be in personally. But I do have the option of short-term getting in, getting out. And so in the short term, I've used this recent strength and knowing what I know about options expiration to take it much more defensively here going into option expiration week. We'll see what happens. I have no problems getting in if market keeps going up because I think it's going to continue going higher. So I'll lose a little bit of opportunity cost. But if options do kick in and we get a pullback, say on the QQQ, I mean, I think I did a count. No, I didn't do the calculation yet on this one. I did the calculation on the Spider last week. And I think the max pain, when I calculated on like Thursday or Friday, the max pain level was like at 399, almost 400. That's the point at which market makers would have to pay out the least amount of money on options. Now, do I think we're going down to 400? No. This is not a literal call. It is a directional call. So 400, if max pain's 400 and I got prices up here at 427, the last thing I want to do is be leveraged thinking we're going to keep going higher when I know it's in market makers' best interest to bring it down. Again, this is the short-term inefficiencies of the stock market. This has nothing to do with the long term. Look at what happened back in March. This was that March 14th low I talked about. This is where we had essentially the lowest close of the year. I think the NASDAQ may have closed at the lowest close. Yeah, right there's the QQQ. On March 14th, options expired on March 18th, that Friday. Look at the next 4 days. A lot of people, thought this was the end of the bear market. Well, most of the rally came during option expiration week. And then look at Monday and Tuesday of the next week. Most of this gain came from during option expiration week and by Tuesday of the following week. And then we went up a little bit more, another 3 or 4%. And then what happened? Right back down again. The downtrend resumed. This was a short-term inefficiency in the market. It was good for market makers to bring prices higher. And don't think that for a minute that if they can make more money, don't think they won't try. So now the thing that makes me a little bit more leery as we move up here is that volume hasn't been very huge. And that's always the case coming off of bottoms. You always see the market sell off on more volume than when it's being bought. Why? Pretty simple. You panic on the way down. I don't know. When we got down to 36, how many people were panicking to buy? Probably not too many. That's the way it is at every market bottom. Probably the biggest nonsense that I've ever heard about technical analysis is when you come off of a bottom and someone says, an analyst says, well, this isn't going to last, volume's light. It was lighter than it was on the way down. It's always lighter on the way back up, every time. That is garbage. Pay no attention to that. This was much more about rotation than anything else. And manipulation. I think manipulation. Look at these gaps. Look at all the big red filled candles back here. This is distribution. Gaps, that's manipulation. That's getting everybody thinking bearish things again. But Wall Street not selling nearly as much as everyone else. Wall Street was actually accumulating back in this phase. Got an interesting video I'm going to be putting out shortly, just to kind of talk about how the Qs and the spider and everything traded during the first 6 months of the year. It's honestly a massive eye opener. Anyway, notice we haven't had a whole lot of big red filled candles the last 2 months. Got a few profit taking pullbacks, but for the most part, we got hollow candles and we're going higher. I think that for the most part is what we need to remain focused on. Now, last week, when I talked about the open, I showed you how discretionary, technology, communication services, these are 3 aggressive groups. They had a good day on Friday. But if you look at last week in total, the S&P 500 went up 3.25%. If you look, where's technology? Right here. Went up 2.44%. Technology actually lagged. It had a good day on Friday, but it lagged last week. I think maybe some of it is starting to have to do with options. We'll see. We're going to find out this week. Consumer discretionary went up pretty much along with the S&P 500, although it did outperform consumer staples by a wide margin again. But when you're looking at the top, you see financials, energy, materials. So what we're seeing is bullish rotation. Other areas now are starting to lead. These are groups, especially the financials, have not been doing very well on a relative basis. All of a sudden, they catch fire. Energy has been a great performer all year, but recently, when I hover over, you can see that big drop in June on that thumbnail, or we can just go take a look at the chart. Big drop here, and so we're kind of coming back. This is a group that probably doesn't have nearly as much in the money call premium as, say, the technology group. Financials also on a relative basis have not been doing as well, but they just caught fire last week, finally. So now we're starting to get this bullish rotation, all 11 sectors higher. And now technology and consumer discretionary taking a little break. And again, wouldn't be shocked if they continue to take a break this week because of options. But now the money, instead of coming out of the market, is going into other areas to send the S&P higher and higher. I'm sorry, but this is bull market behavior. This isn't bear market behavior. And I know if we get a pullback this week with options and we go back down to that 20-day or even close to it, everybody's going to be back out. Oh, that's it. The end of the bull market rally, or the bear market rally, I should say. And I'm going to look at a lot of these, and I'll be looking at headline or necklines. Any pullback's going to be a right shoulder in a bottoming head and shoulder pattern. It's going to set up perfectly for the next entry. I would love to see the market pull back to the rising 20-day EMAs. I mean, I'm just concerned that the bull market's in such high gear that it's not going to pull back that far. But this would be the perfect opportunity for it to do so. We'll see. Other sectors, here's technology. So we did slow down on a relative basis last week, but you can see, I mean, when I look at the chart, there's always a level. After coming out of a bear market, there's always a next level that you have to conquer, which makes it hard. because when you're coming back up, you set the first high, you pull back, then you got to take that high out. Okay, we did that. Got through the moving averages. We did that. We successfully tested the 20-day on a pullback, did that. All these are check marks. Then you've got, this is a downtrend, lower low, lower high, lower low, lower high, lower low. Got to get through that lower high right there. Did it. So then you break through this level. So there's that one. All right. Then you got, what about this one? All right. Check. All right. How about this gap resistance right here? Okay. Got that one. Here's more gap resistance. All right. Let's, get this triple top right here. And I'm just doing this on the XLK, but same exercise on the major indices. You can kind of see right there, triple top. That's obviously going to be a really big one. This could be a massive left shoulder, neckline, head. We could make our way back up, and then maybe at some point in the fall have one more pullback that could scare everybody to put in a right shoulder in what would be a much, much longer term. This would be an inverse head and shoulders as opposed to a reverse head and shoulders. Reverse head and shoulders is a bottoming formation off of a downtrend. Left shoulder, blah, blah, blah. Maybe draw on this one down here or something. I don't like downtrending necklines. But anyway, there's that. But when you're coming off of a top and you see a head and shoulders, a reverse head and shoulders, that's a continuation pattern of the longer term uptrend. And that's what I think we're forming. Call it a cup, call it a inverse head and shoulders, call it whatever you want. But I think we're eventually forming a pattern that is going to be a long-term continuation pattern that simply started off as a short-term cyclical bear market. That's what it all looks like to me. I wanted to show you the sentiment. So here's options, equity only put call ratio. So this was last year where we were routinely having readings down below 0.4. I mean, if we go back a couple years, look at all these readings down to 0.3s. The most complacent I have ever seen the options market. Everybody, all the memes, stocks, all those Wall Street bets and Reddit traders, all the new traders to the market. This was an ATM machine back here. Stock market was an ATM machine. Everybody was a great trader. There were so many new Warren Buffetts that were created during that year. That's all sarcasm, by the way. They just needed one rude awakening. And that was the top at the beginning of the year. Fortunately, we talked about it, saw it coming. A lot of EarningsBeats members in cash, or certainly much more cautious. Look at the resetting of sentiment. Look at how we've steadily been increasing this equity only put call ratio. We got up here, we had a reading up near 0.90. You can look down here, 0.60 was a big deal for 2 years. Then we got to 0.90. Look at the 5-day moving average. Got to 0.825. Look at that peak. And look at the bottom in the S&P 500. That's a thing of beauty. When you peak and you roll over from elevated levels like this, look at these little peaks right here. Look at the market, bounce, bounce, bounce. Right now, we've got stuff going the other way. And a lot of times when you turn up from these, look at this bottom right here. That was the market top right here, little top. You go over here, market top, right here, market top, right here, market top. Things are starting to get a little bit complacent. So this would be another reason why you could argue the market is due for a pullback here with options expiration week. So I just want to make sure everybody's aware of that. Let me show you what I'm talking about with options. And I'm going to talk about this more. I know it's 9:30. I'm going to try and get through this real quick. This is the spider over at the CBOE. This is the August 19th monthly options, and it shows us the open interest on the call side and the open interest on the put side. Now, keep in mind, we were trading at what, 424, 425 on the S&P 500. So any strike price below 425, these calls are in the money, meaning that whoever owns these calls has the option for every call they own, they can go back and buy the SPY 100 shares at $185. That's a no-brainer when it's trading for 424. If I tell you that something's trading for $424, and oh, by the way, you can buy it for $185 if you'd like, of course you're going to exercise. Or you're just going to sell and take a huge profit on those calls. I mean, basically the profit's going to be the difference between the strike price and the current price. Anyway, as you go down through here, now remember, 425, look at all of these in the money calls building, starting back here at 360, 361, 362, 17,000 at 375, 34,000 at 380. Let's see, what else do we have here? How about 40,000 at 400, 22,405, 28,410, 24 and 28,000, 14, 415, 35,000 at 420. Lots of in the money calls. How many in the money puts do you see above 425? Let's see, 4,500, 22. Here's 14,000, 2,700, 8,200, and that's about it. Almost no in the money puts. Massive, hundreds of thousands of in the money calls. So all these options traders have to be paid out. Unless, what happens if the spider were to drop $10 from 425 to 415? Now look at how many in the money puts there are. And all of these in the money calls become worthless. And so now all of a sudden you're getting more value on the put side and less value on the call side. And that's how you work directionally toward max pain. I just throw it out there. Hey, sometimes max pain has no impact. I will not be shocked if we are sitting here next Monday and the stock market's higher than it is right now. So this isn't a guarantee. We're talking about risk. Very big difference. You know, I don't want anyone to say, oh my gosh, I put my life savings into puts because you said the spider was going to go down. No, I didn't. I said the risk of the spider going down is extremely high. But I'm not saying it's going down. Market makers, when folks are buying calls, market makers are selling those calls. Now, if they're truly idiots, then they're just selling the calls and they're doing nothing else. Now, if they're smart, they're selling the calls and they're buying the underlying stock. That is a covered call strategy. They cannot lose if the market keeps going up. Why? Because they bought the stock to offset the call. They're actually going to make a little bit of money. It will be the premium that they make on the option that they collected. That premium they collected is going to be their profit. The fact that they bought the stock covers the value of the option going higher. So I don't know what market makers do. I've never worked for one. I just assume that they're smarter than taking naked call options and just shorting. You could lose a lot of money. You'd be out of business as a market maker one bad month. So if you know anything about betting football, you got bookies. Bookies do the same thing. They're effectively, they get a lot of money on one side or the other, and their book is unbalanced, and they take some of that money and they put it off to another place because they don't want all that risk. That's exactly what market makers do, in my opinion. So you've got to understand what's going on into option expiration week. And I'll talk a lot more about this at our member Max Pain event, which is tomorrow night. at 4:30. Go to EarningsBeats and sign up for a 30-day free trial. This is a great time to try our service. It's going to be some interesting stuff going on over the next 30 days for sure. September's right around the corner. You know, historically, not a great month. All right, let's go ahead and wrap this thing up. There was one earnings report of any significance this morning, and that was Li Auto, LI. So it's a 24, almost $25 billion market cap company. You can see it traded down with its earnings. So it is down this morning just a little bit. But that's a key area of support right in there. And you got the 200-day moving average, which I'm not a huge fan of. I usually don't even have the 200-day on my charts just because as a short-term trader, why am I looking for a 200-day moving average? I should be looking at a 20-day or a 5-day. Or if you're shorter term than that, maybe something intraday. But 200-day moving average for a short-term trader, that's kind of crazy. That's like being in the stock market, not being worried about where the stock market is until, the year 2050, and then coming in and looking at an hourly chart. I mean, it doesn't make any sense. So anyway, that's the one stock. Let's pull that up on a regular chart here. So it's trending down, but we do have a couple tops coming in here, right around 32, 30 to 32. You can see several tops. We finally broke out above that level on increasing volume. So I'd like to see this 30, 32 level hold. AD line's been going up for the past 3 months. So morning weakness normally could be bought in a stock like that. That's why we use our strong AD chart list. Anyway, that was one stock. Let's see, what else do we have for today? See where we are. Look at NASDAQ's already gone green. It was red pre-market. S&P still down 17, Dow up 160. It's just hard to kill the market right now. One thing I did tell members over the weekend, one stock I liked was Moderna, and that's the top performer in the S&P 500. We're actually introducing a new model trading portfolio this week. And so I just pointed this out as being one that I would consider starting next week. That's the kind of stock that I would look for. So we'll make this one the last stock that we look at today. But here was that earnings related move by Moderna breaking out. And then look, it hasn't participated. That's the thing I keep, telling folks is when you're on the long side, you don't have to stick with the ones that just keep going up. I like to trade, take my profits on those and look for stocks like Moderna that had a big move up. And then because healthcare wasn't very strong, it pulled back. Bull markets constantly see rotation from sector to sector to sector. So if technology and consumer discretionary end up being weak coming up this week, there's a chance that healthcare takes off. Well, if healthcare takes off, Moderna has got a really good shot being down near, this was gap support with earnings. There's a 20-day test. This is a chance for Moderna to make a pretty big move. So it opened at 172.85. So it's made most of this move today since the opening bell. So this is a nice looking chart. Anyway, that's what we try to do at EarningsBeats. Our mantra is better timing, better trades. That's our tagline. I mean, that's what this trade on Moderna is all about. It's trying to time the trade so that you get in right when it's ready to go. And if it doesn't, you could put a fairly tight stop. I mean, I'd be nervous if it broke below the 20-day and that gap support area. So you don't have to risk a whole lot. In the meantime, if we are in a resumption of the secular bull market, there's a good chance Moderna not only goes up to test this high, but breaks out again. So getting it on a 20-day test makes a lot of sense. Anyway, that's it for me. I appreciate everybody tuning in. I'll be back tomorrow with a recording over at Stock Charts TV. So at about 9 o'clock tomorrow morning, Tuesday morning, and also on Thursday morning, if you click on this Stock Charts TV link, when it comes up, it'll say now playing, and it'll be my show. So remember that Tuesday and Thursday mornings at 9 a.m. Anyhow, that's it for me. Everybody have a great day. Be back over at Stock Charts TV tomorrow morning. Happy trading, everybody.